All right, let's get right into it. Today, we're breaking down an investment research note on a really fascinating and, frankly, one-of-a-kind chemical company called Paushak Ltd. And it's a real paradox. See, on one hand, its business looks like a totally impenetrable fortress. But when you look at the financials, you find this strange, puzzling leak. So what's the deal? Let's figure it out. So, to really get what Paushak is all about, you first have to understand this one chemical, phosgene. Now, you might have heard of it, and probably not for good reasons. It was notoriously used as a chemical weapon back in World War I. But here's the twist. Today, it's absolutely essential. I mean, it's a critical building block for everything from pharmaceuticals to high-performance plastics. The catch? It is incredibly dangerous and a nightmare to handle. And that's exactly what Paushak does. Their entire business is built around mastering this one highly hazardous chemical. And when I say they'd mastered it, I am not exaggerating. They are in a completely different league. Just think about this for a second. In all of India, a country with over 1.4 billion people, how many companies do you think are legally allowed to manufacture phosgene? The answer is two. Just two. And Paushak is one of them. So we're not just talking about a strong market position here. This is basically a duopoly, protected by some seriously massive walls. Okay, so that leads us right into the first part of this story, what analysts call the company's unbreakable moat. Now, if you're not familiar with the term, a moat is just a fancy way of saying a competitive advantage, something that makes it almost impossible for anyone else to even try to compete. And let me tell you, Postuk's moat is one of the widest and deepest you're ever likely to see. I love this quote because it just paints the perfect picture. Think of their business like a medieval fortress, right? The walls that are protecting it, they're not made of brick and stone. They're these incredibly complex, high-tech safety systems. And the gatekeepers, the ones who decide who gets in, not guards with spears, we're talking about government regulators. And the moat itself, the big ditch around the castle, well, it's literally filled with phosgene. Yeah, good luck trying to cross that. And here's the thing, all these barriers kind of feed into each other. You can't even dream of getting a government license unless you have decades of experience proving you can handle this stuff safely. But how do you get that experience? Well, by spending a fortune on safety infrastructure. And hanging over all of this is the historical shadow of the 1984 Bhopal gas tragedy, which, by the way, involved a phosgene derivative. Because of that disaster, the Indian government is, understandably, extremely hesitant to issue any new licenses. The gate is basically locked shut for newcomers. So, you might be thinking, okay, great fortress, but what exactly are they protecting? And this is the key. This isn't some tiny niche business. They're guarding the supply of something absolutely critical for essential industries. Look at this. Over half of what they make goes into pharmaceuticals. We're talking life-saving drugs. Another big chunk, about a third, goes into agrochemicals. You know, the stuff that helps us secure our food supply. This isn't a luxury product, it's foundational. And here it is. This is the central mystery we're trying to solve. You've got a company with a near monopoly, they make something that everybody needs, and pretty much nobody can compete with them. You'd think their financial results would be flawless, right? Like a money printing machine. Well, they're not even close. So what on earth is going on? Let's move into the second part of this. We're going to look at the numbers that are raising some eyebrows, what the analysts are calling the short-term squeeze. This chart right here really shows the core issue. This is their operating profit margin. Basically, how much profit the company makes from its main line of business. And as you can see, it's been falling. It peaked at a very, very healthy 36%, but more recently, it's dropped all the way to 25%. That is a significant erosion of profitability. You do not want to see that. And the pressure is showing up everywhere else too. Sure, profits are down, but look at these return numbers. Return on equity and return on capital, these just tell you how efficiently a company is using its money to generate profits. And, well, they've fallen off a cliff. The ROEC, for example, has been nearly cut in half. That means the company is getting much, much less profit for every single dollar it invests in the business. So, we're back to that big question, the one this whole research note is trying to figure out. How can a company with almost no competition be seeing its profits get squeezed so hard? Is the moat not as strong as it looks? Is there a crack in the fortress?
Well, the answer, it turns out, is a combination of three things. First, the cost of their raw materials has gone up. Pretty standard issue. Second, they have higher expenses because they're in the middle of launching a brand new plant. But the third reason, this is the big one. They've built this huge new production capacity, but it hasn't started generating any revenue yet. So right now, it's all cost and no income.
And that leads us perfectly into the final act of this story. Because this financial squeeze, it isn't an accident. It's the direct result of a massive, strategic bet the company is making on its own future. How big of a bet are we talking about? Over 300 crore rupees. Now, to put that in perspective, that is more than the company's entire revenue for a whole year. This isn't just a minor upgrade. This is a company-altering level of investment. They are, quite literally, betting the farm. So what did they spend all that money on? Well, first, they tripled their core Phosgene production capacity. Huge step up. But more importantly, they built a new plant for what are called downstream derivatives. All that really means is they're moving up the value chain. Instead of just selling the basic, hazardous ingredient, they're now using that ingredient to make more complex, higher-value chemicals themselves, specifically sophisticated ingredients for the pharmaceutical market. So now it all starts to make sense, right? The financial pain we saw earlier is the temporary but necessary cost of this transformation. They are fundamentally redefining what the company does. And you know what's really impressive? They've managed to do all of this almost entirely with their own money, taking on very little debt. It's an incredibly bold move, but a fiscally responsible one. This brings us to the conclusion, the final verdict from the research note. We've got to weigh the risks and the potential rewards to understand the two very different futures that could be in store for Paushak. So on one hand, you have the bull case, the optimistic view. The bet pays off, big time. The new capacity fuels massive growth. They capture new global clients who are part of that China plus one trend of diversifying supply chains. And their profit margins expand as they sell these new higher value products. On the other hand, you have the bear case, the pessimistic view. The bet fails. The new capacity just sits there, underused. Margins stay low. And given the business they're in, a single safety or operational incident could derail everything. So after weighing all of that, what's the final call from the analysts who wrote this report? They rate the stock as accumulate with a 3 to 5 year time horizon. They believe the company's fair value is significantly higher than its current price, which suggests that the potential reward from this massive expansion outweighs the short-term risks. So in the end, that's the story. A company with an almost perfect business moat that has intentionally sprung a leak in its own financials to fund a massive expansion. The entire investment idea comes down to this single question. Is this a brilliant, company-defining masterstroke that will pay off for years and years to come? Or is it a risk that's simply too great? I guess only time will tell.